Today, we're unpacking the recent Q2 earnings call for Dave & Buster's, and wow, it was a wild one. This was a report that absolutely sent shockwaves through the market. We're talking about a story of sky-high expectations meeting a really brutal reality, and what happens next? An immediate, full-blown reset under a brand new CEO. So let's get right into it.
You know, everything that went down really starts with this one single number, negative 54.6%. That wasn't just an earnings surprise. I mean, let's call it what it is, an earnings miss, a massive one. This was a shortfall so big it caught Wall Street completely flat-footed, and you can bet it set a really negative tone for everything that came after.
All right, so here's our game plan for today. We're going to start with that initial earnings shock and the sell-off that came right after. Then we'll dig into the new CEO's diagnosis, what he thinks went wrong, and his 5-point plan to fix it. And we'll wrap up with our own prediction for what's coming down the pike.
Okay, first up, the Q2 earnings shock. Let's take a look at the numbers that really startled the market. So, what was actually in this report that got investors so spooked? Well, it all boils down to a couple of key numbers that just completely missed the mark.
And here's the big one. I mean, look at the size of this gap. This is what really stunned people. The street, the analysts, they were all expecting an adjusted earnings per share of about 88 cents. What did Dave & Buster's actually deliver? 40 cents. Just 40. That's less than half of what was priced in. In the world of quarterly earnings, a miss of this size isn't just a red flag, it's a blaring siren.
And it wasn't just about the earnings per share either. The pain was felt elsewhere. Yeah, revenue came in a little light, but the number that really got investors worried was the comparable store sales, or comps. They fell by 3%. And that's a big deal, because it signals the weakness isn't some weird one-time thing. It points to a real softening in the core business.
Okay, next section, an immediate market sell-off. Let's see how investors reacted in those first few minutes. And with numbers like that, well, the market's reaction was exactly what you'd expect, fast and brutal. There was no let's wait and see. Nope, the judgment was swift and it was harsh.
The speed of this thing was just incredible. So the market closes at 4 p.m. with the stock sitting at $24.19. The earnings hit the wire and bam! Within 7 minutes, just 7 minutes, the price had cratered by about 15%. That is literally the market repricing a company's entire future, right there in real time.
And you might think, okay, maybe it was just a quick after-hours panic, right? Wrong. The negative feeling just stuck around. It deepened overnight. By the next morning's pre-market trading, shares were down even more, around 17%. That tells you this wasn't just a blip. It was a real, sustained loss of confidence from investors.
All right, so now we get to the new CEO's diagnosis. We're going to hear from Tarun Lal on why he thinks the plan failed in execution, not strategy. I mean, imagine this. You're the new CEO. You've only been in the job since July, and you have to walk straight into this firestorm. His first big test? Facing angry investors and explaining this mess. And his argument was simple and direct. Hey, our strategy isn't the problem. Our execution is.
And here's the quote, straight from the horse's mouth. This was really the core of his whole message to the market. See, by calling it a very clear executional failure, he's doing something very specific. He's telling investors, look, these are not mysterious, unsolvable problems. We know what went wrong, we can manage it, and most importantly, we can fix it. And crucially, they can fix it without having to scrap the entire game plan.
So what exactly were these so-called failures? Well, the CEO didn't hold back. He laid them out pretty clearly. On the left, you can see what wasn't working. They moved away from TV ads and instead ran confusing promotions. They cut menu items that people actually liked, and they weren't putting out enough new games. On the right, you see the fixes they're putting in place right now. TV ads, they're back. Promotions, they're simpler and more focused. That popular food, it's coming back. And new games are already being rolled out. It's a pretty direct reversal.
Which brings us to the plan itself, the 5-point turnaround plan. This is the new strategy to get back on track. Because look, the new CEO didn't just show up to point fingers at past mistakes. He came with a clear 5-part plan to actually get this ship turned around. So here are the 5 pillars of his strategy. Number 1, marketing. Get back out there with a message that actually makes sense. Number 2, food and beverage. A back-to-basics menu, which is basically code for bring back the stuff people loved. Number 3, operations. Pretty simple. Focus on making sure guests have a good time when they're actually in the store. 4, games. A steady pipeline of at least 10 new games a year,
with some exclusive titles you can't play anywhere else. And finally, number 5, remodels. They're going to revamp the store makeover program to be smarter and cheaper. You can see how each one of these is a direct answer to one of those failures he called out earlier.
Okay, so talk is cheap, right? What are the actual signs investors should be looking for to see if this plan is working? Well, here are some things to watch for in the very near future. That Back to Basics menu, it's launching nationwide in October. They've got new season passes coming out. The new, cheaper remodel design is about to make its debut, and they're rolling out new games, including a really popular one called the Human Crane. These aren't just ideas, they're tangible things you can track.
All right, so that's the story so far, the diagnosis and the recovery plan. But now comes the big question, especially from an analyst's point of view. What does all this actually mean for the future? It's time to dig into the guidance and make our own call, our prediction for what's next. And to really get a handle on where things are going, you have to look at one of the biggest changes they announced, a massive shift in their long-term financial targets. So, what does this new target really signal to investors? And believe me, this wasn't just a little tweak. It was a complete and total reset of expectations.
So let's start with the old goal. Before all this, the company had put out this really ambitious target. They were telling investors they were aiming for $1 billion in adjusted EBITDA. That was the big, shiny number on the horizon, the North Star everyone was tracking.
And then the reset. The new CEO comes in and sets a new target, $675 million. Now here's the kicker, and this is super important. He also revealed that his own pay is now tied to hitting this new lower number. That's a huge signal to the market. Yes, it's a massive step down from $1 billion, but it's also being framed as something they can actually achieve, a goal that the new management now has a very personal, very financial reason to hit.
And hey, just so we're all on the same page, let's quickly talk about adjusted EBITDA. It's a really important number for investors. Basically, think of it as a way to measure the company's raw operating performance. It's cash flow from the business, before you factor in stuff like interest payments, taxes, or accounting quirks. It gives you a pretty clean look at how profitable the core business really is.
Okay, so putting it all together, here's our official take for the next call. First, next quarter's results. We think comparable sales are probably still going to be soft. Look, a turnaround like this doesn't happen in 3 months. The key thing to watch will be if their profit margins start to stabilize as some of the extra costs from this quarter go away. As for the stock price, we think it's probably going to be stuck in a range for a while. It's not going anywhere until the company can deliver some real proof of life in its sales numbers. This is a classic high-risk, maybe high-reward situation. So for now, here at Talk Tickers, we're giving it a market perform rating.
And really, that's the bottom line here. The whole story has changed. We've moved past the turnaround promise phase. The market has heard the new CEO. They've heard the plan. Now it's all about a demand for proof of life. The next few quarters are going to be absolutely critical. It's all about execution and proving to investors that this big reset isn't just talk, that it's the real start of a real recovery.
This is not financial advice.